Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining us. And this is an important episode tonight because we're going to be looking at reporting season and trying to work out whether there's a buying opportunity from some of the big sell-offs, and also if the stocks that we're going to be looking at should be actually in your portfolio or should be jettisoned from your portfolio. Joining us will be Adam Dawes of Shaw and Partners, and then Paul Rickard, of course, of the Switzer Report. So without any further ado, let's go to Adam Dawes of Shaw and Partners. Thanks for joining us, Adam.
It's great to be here, Peter. Thank you so much.
Well, it's a good time to talk because this is post most of the companies have reported. What's your feeling? The outlook statements always give you that feeling about what this market can do. What's the view of Shaw and Partners in terms of where this market can go?
Yeah, I mean, we are looking a little bit long in the tooth on this bull market where we are at the moment. And there's a couple of reasons. One of the reasons when I see that we're at the sort of the longer end of the bull market is that we see a lot of these smaller companies going 1,000% or 500% up on some news that potentially might not have really moved the dial 6 months ago. But, we're seeing a lot of those small caps starting to move. Look, I think overall earnings season and earnings reporting was 50-50. There really wasn't a real sort of standout on the beats and real standout on the misses. And obviously, as you well saw, if you did miss, you were down 20%. And if you did, hit and go above, well, then certainly, the market really rewarded you for that. But so I think overall, I think it was a good reporting season, but I'd like to see some more direction in those outlook statements. And that's where I think a lot of companies fell over in that later stage was the outlook statements.
Yeah, I'm trying to work out whether I should be making more of my clients more defensive, but I do think we still have a lower interest rate environment. Yes. That's good for stocks. I do think Trump's going to keep working to keep the market going up, and I'm kind of gambling that I want to be growth oriented at least into 2026. How risky do you think that is?
Oh, look, I look, even if we have a small sort of pullback, 9,000 was a big number and we're sort of hovering around that at the moment. So even if we have a 200, point pullback, it's not gonna really derail this rally. So look, I think you're right. Interest rates are coming down, though those CPI numbers that came out for Australia last week were a little bit high on that upside. So yeah, maybe that talk of 2 interest rate cuts is going to get pulled back to 1, but I do feel that is going to keep the market moving forward. I agree with you on that.
And it seems to me a lot of companies that do better with lower interest rates. I'm thinking Tyro. Sure, Tyro's got suitors out there as well, but the suitors wouldn't be there if they didn't think that the interest rate environment is going to be good for a company, a payments company that obviously borrows a lot of money to be in the game. So I think, and you mentioned there's some small caps are going up 500, 1,000%. That's also in the probably the context of lower interest rates, probably an improving economy because of lower interest rates down the track. So it's not totally against what you might think is the macro interpretation of what stocks could do.
Yeah, absolutely. There is still room, and there's certainly some of those blue chips that we called them landmines. You step on it, you hear the click, and oh geez, here we go, and then all of a sudden, stock just gets pummeled. So there are a couple of those landmines out there, especially in the blue chip land, that are looking really, really good. So it is pulling back some of that valuation. But 9,000 is a big level, and I think it's going to take some time for the market to digest that number. For it to move forward, and certainly BHP has to be back up to $50 for it to really start to kick, and that's a little way away at the moment.
Yeah. All right. Let's quickly go through some of the big caps or the big stocks of interest, and one of course is CSL. Now CSL copped a very big sell-off. The report wasn't that bad, was it, Adam?
No, I didn't think it was that bad. I think it was certainly a downgrade. Like there's no two ways about it. It was a downgrade on the earnings and the guidance, but I think it was more of a strategy miss to the market, if that makes sense. Yes, we can handle an earnings downgrade, But it was all about the strategy and how they said, look, we're going to save lots of money. We're going to take out stores. We're going to diversify. We're going to spin out, demerge that Sequirius business. So, and I think that, shareholders potentially saw that as a little bit of a red flag, that potentially, they're trying to hide something. They did actually give some guidance, which was great. And so I don't think anything's lost. I think this thing is just looking like there's a bit of a re-rate that's going to happen on CSL. But certainly, I think, we're buying some down at these levels, 210, 211. I don't have a problem with it. I'm sort of more happy to average down for clients. And I'm starting to put it back into portfolios, because that is one of the stocks, obviously, that hit a little bit of a bump, landmine, got hit hard. But I think it was more of a strategy miss. I think that they could have relayed that strategy of how they're going to do these things, and not try and, maybe make that the focus versus the downgrade. So I think it was just a messaging error. But in saying that, a downgrade is a downgrade, and they certainly got hurt.
The consensus is 33.7% upside. The most optimistic is Citi and UBS up 41.9%. But 6 out of 6 analysts agree with you that they like the company at this price. And I think the important point to make with CSL is that there is talk there that AI bots are actually having a bit of an impact in both directions. Yes. It seems like excessive buying on some reports that aren't all that good, and then the excessive sell-offs. Do you think that this is something we're going to have to get used to now?
Oh, look, I think we've been playing with bots now for a couple of years. As a retail broker or broker that deals with retail, we don't put the orders through the bots. Yeah, we don't put it through the order box and it just does it for us, over the day, VWAP, that kind of thing. So we need to compete with those bots, and competing is especially something like a CSL. You can't really put a line of 1,000 CSL to buy, because the bots know it's a real order, and potentially they'll move away from you to get you to pay higher prices or lower prices if you're selling. So look, yeah, absolutely. It is really aggressive. The bots are very aggressive. They don't do a lot of price discovery, which is good, because if you did price discovery, they would continue to keep rolling all the way down. But look, I think overall, it's something that we're going to have to get used to, and it's high frequency trading. The ASX loves it because it gives more volume.
Yeah. I'm going to talk to you about this in the future, but it seems to me that AI is good at telling us what has happened in the past, and we can use that ourselves when we're trying to work out. But I'm not confident that they're great at necessarily predicting the future, and that's where we make money. So I think they could actually create opportunities. If they've driven the CSL price down too far, well, then as a dollar cost averager, it could be an opportunity. But it's going to be a wait and see situation, isn't it?
Well, one of the things that I think the biggest two factors that move our market is fear and greed. Now, AI is going to struggle to know or understand those two very large emotions that we are inherently human, and we are being driven by that fear and greed. So when AI tries to then get their head around it and try to move it forward, it struggles, because it doesn't understand how humans, fear as well as greed, work. So it is very difficult, but yes, you do need people like us, Peter, to talk to.
Without doubt, couldn't get better people. Let's go. And I guess James Hardie is another one, a bit like CSL. What's your view on James Hardie going forward?
I think it was all about the outlook statement for James Hardie, and we then saw Reece confirm that in their overall statements about the US market, that there is going to be a soft 12 to 18 months going forward, and James Hardie said that in their announcement as well. Quite interesting. James Hardie actually went by segment as well, which they don't usually do. They usually give an overall view, but they actually gave segment by segment, which gave the market a little bit more understanding on how the business is actually working. Well, it wasn't the best side of it, because there was downgrades in most of those sectors as well. Look, overall, I think James Hardie looks okay here. I'm caught in this landmine. I'm stuck in it at the moment. It is moving sideways. I think the deal that they did, and you're going to remind me of the other group,
Aztec, ATEC.
eight, yeah.
Yeah. I look
I
like
think that
Aztec,
was.
but it's good ATEC. Yeah.
I think that was a bad. It was a bad decision, bad move for James Hardy shareholders, not for the other party. And so I think, yeah, that's what's really sort of kept this stock down, and we haven't seen that nice V-shaped recovery that we have seen on other ones.
Is it a dollar cost average play?
I think you got to wait. I think this one, I think it's got to do some time down here at $30. I think it's got to do a lot of time down here, soak up some of that bad news. I think all the bad news is out. There's no doubt about that. But I think we've got to soak up some of this sideways moment. So not yet. I continue to wait, and potentially there's a little bit more weakness in that US economy, albeit we're seeing interest rates coming down. It's just it's going to take some time.
Okay, next DC reported well, market liked it, had been clobbered for a few months, hadn't it?
Yeah.
But they still like it, the analysts. 6 out of 6 like it, 19.9 consensus. UBS the most positive on 27%. What's Shaw and Partners saying about next DC?
Well, next CC, I mean, it was a great result, and gladly I did buy some for clients previously. So, we got through on that one. Look, it's probably one of the only ways to play AI here in Australia. I mean, you got Next DC and you got Goodman Group. Really, they're sort of the forefront of that AI. In the large cap space, I better say, versus some of the smaller cap, which there is AI in there. But look, I thought overall the result was quite good. They gave some really good guidance, and I think that's the key and the reason why the stock rallied. And they're certainly going to be adding more data centers here in Sydney as well, which is what they need. So look, yeah, really comfortable with that one. It looks good. I would probably wouldn't be buying too much here. But I think overall, it's a great stock, and it's certainly one for the portfolio for 2026.
To our other great tech stock, Xero. Is it in the buy zone? It's come off the boil lately, and historically, every time it comes off the boil, it has proved to be a buying opportunity. What do you think?
Yeah, look, yes is the answer. I looked at the chart today and I was like, oh, geez, it looks a little bit, it does look like it's rolling over here and continuing to fall. I think they've just got to make the market feel aware and comfortable about the movement into the US. And we know Intuit is the biggest and leader there, and they're in the top end of town. Xero is going to be going to the small to medium enterprise businesses. There's about 8 million businesses in the US that they can go there. But surveys have said, and excuse the pun, that they know zero about Xero. So it's about confidence. It's about advertising, and there's capex that's going to need to be done. So there's still some work. Comfortable with Xero. I'm always happy, but I think you just got to be a little bit careful. That chart doesn't look that great at the moment.
Okay. So let me boast. I got BHP and Rio right 6-9 months ago when it was what, 35, $36. But now the analysts don't see much upside from where it is today. 1%, 1.8%, 4 out of 6 like it, both companies. What's your view on BHP? Are you a buyer or a holder?
Certainly a holder of BHP, and it's a core portfolio stock, no doubt about that. Great dividend, happy to be there. Iron ore is holding. BHP's changed their movement a little bit. They're more copper these days as well. I mean, it's iron ore and a copper story, and that's great because copper, we all believe that copper is going to continue to rally. So look, we're really comfortable with that. Rio, look, again, really comfortable. Certainly iron ore is the big play there, and has been holding that $105 quite nicely. BHP, you'd probably be a seller at 50. Because traditionally it hasn't got there, but it's moving in the right direction to go there, and certainly Rio, anything above or anything under $100, you'd be buying this in with your ears pulled back. So I don't mind. I prefer BHP over Rio just for that diversification and a bit more stability.
If there's a positive China deal, do you think that's going to be good for commodities and all that sort of stuff?
When you say positive, you mean as
in
it's
between Trump and
Paris?
Yeah.
Yeah, look, yes, it will loosen up the economy. They will then probably stimulate into the property market, which will then, naturally we will do better on the back of that. The problem is with China, it's been a consumer-led push, not a property-led push, and that's left BHP and Rio a little bit out in the cold at the moment. But, yeah, I think that tariff deal will definitely calm nerves across all of Asia, I guess around the world. America needs China. China needs America. They just got to work it out.
Okay, a couple of quick ones, mate. I wanted to talk about lithium. So, of course, I went and looked at PLS, and I was
Yeah,
surprised to see that the analysts are pretty negative. But then I looked at the 6-month chart and saw, well, it is up 22%. So,
yeah.
from my point of view, is that they're not saying lithium's dead in the water, but it's already had a nice run. Is that your
Yes.
take on it too?
Yeah, look, it has had a good run. I think it's more still a 2026 story. Once the demand, we know demand's there, supply is still needed to be curtailed, pulling out, which is then going to bring it forward. PLS, Min Resources is UBS's #1 pick in the lithium space for iron ore and lithium. They reckon that's looking a lot better than PLS. PLS still struggling with lots of shorts out there at the moment, and they're staying short on it. So I think you'd be careful on PLS. But the lithium story, 2026, yes.
Okay. So, and finally, Paladin and uranium. Analysts 7.9%. The most optimistic is Shaw and Partners, up 28.5%.
Yeah.
And then, you guys have got uranium right before. You think this is another good opportunity to give it a crack?
Yeah, look, I'm really comfortable with the uranium story. However, there is some red flags on that Paladin side of things. We've got to buy on it, so I'm going to stay with our analysts on the buy. But there is some cash flow issues. There are some other issues inside of Paladin. But if you take all of that out, we do know uranium is going to look positive and will be positive because we saw Kazana Petron. I've got the name wrong, but another large uranium producer has to go into the spot market to buy its uranium because it can't produce enough uranium for its contracts that it's got offtake. So there's a classic example of a very large uranium business not being able to take or pay, and has to take it in the spot, which is going to increase the uranium price. So yeah, positive on that. It's just going to take some time as well.
Okay, one last one before we go. Of all the stuff you saw over reporting season, what is the Adam Dawes destroyer? The one that's going to really be a great performer?
Okay, so there was two TLX, still getting sold down at the moment, but let's come back and talk about that in 6 months' time. That should be above $20. It's currently $14. It's $15 at the moment.
Okay.
So yeah, TLX, I think that's going to get sorted out, and that's fine. And the other one I'm going to stay in the top 50 is Sigma, Chemist Warehouse.
Yeah.
There's a lot of money that needs to find a safe home, and Chemist Warehouse is a fantastic one. Looks a little bit ritzy here at $3.10, but I'm putting it in clients' portfolios. The dividend's going to increase, and it's a fantastic business. So there's two. Therefore, you asked for one.
Okay. Well, 6 months' time, we'll revisit it, and we'll either call you the greatest stockbroker in Australia.
Well, you already have called me that, so you can't take that away from me.
Yeah, well, I was just sucking up to make sure you came on the program. All right, mate. Fantastic. Thanks for joining, Adam.
Thank you. Great to be here.
That's Adam Dawes of Shaw and Partners. And that was Adam Dawes of Shaw and Partners. And now let's cross to Paul Rickard, who's in his country property, but he's still thinking about money, as Paul always does. Paul, thanks for joining us.
Thank you, Peter.
So let's look at reporting season in total. I asked the same question of Adam Dawes. Does the feeling you got that you're happy to remain long stocks given what you've seen in reporting season?
Yeah, I think, Peter, you just can't ignore the trend at the moment. So on that basis, I'm happy to remain long, but I'm a little wary. And reporting season was a touch underwhelming. So I think there's some good reports. I think some of the consumer discretionary stocks that are going to benefit from lower interest rates. Certainly the economy seems to have been stronger in the fourth quarter of last year and also the first 2 months of this year. So I think there's some flow through to those stocks and they're reporting an uptick. But overall, I think generally it was, although the stats say there were more beats than misses, I think it was a bit weak. And I think as a bull, you've got to sort of just take the lead from the US. And well, while it's there, while lower interest rates are on the agenda, I guess you stay long. But I'm not putting more cash into the market, if that makes sense to you, Pete.
Yeah, sure. But Paul, if you look at it in terms of, we know the economy has slowed, and at one point we're wondering whether we might get a negative reading. We probably won't get that. And we know interest rates are coming down, but they're not coming down as fast as we would expect. But it's kind of like, all right, it's slow, but you made the point. Consumer discretionary is likely to benefit from lower interest rates. I think Harvey Norman soared on Friday. So it's kind of like, it's not overwhelmingly positive, but there's not enough good enough reason to be negative and going excessively defensive. Is that a fair call, do you think?
Yeah, I think that's a fair call, Pete. I don't think you can be excessively defensive at the moment. There's just not enough justification. You can be a little scared because there are some scary things happening,
Yeah.
but and including the market, at the level of the market, and that's why I
Yeah.
think it's important to keep some cash on the sideline. But I don't think you can be excessively negative at the moment. Interestingly, Peter, just coming back to the month of August, we really did see a lot stronger performance from the small caps and mid caps.
Yeah.
So whereas the overall index with with interest, sorry, not interest, with dividends was up 3.1%. The mid caps are up over almost 6%, and the small caps rose by 8%. So definitely we're seeing more interest and a move towards those companies that will benefit more from lower interest rates. And I
Yeah.
think there is money flowing out a little bit at the top end of the market.
Yeah. Well, you and I did talk earlier over the last year or so that something like X20 was going to be a beneficiary as the big caps lose momentum. That has to bring down, say, VAS and all the other indexes temporarily. But once they hit some sort of a bottom, they'll probably come back. But, I think you're right. That's what we're seeing, lower interest rates. And the more interest rates come down, the more that will probably work. Paul, I know you did a story on CSL. And let's just be really blunt here. Is it a buy at these levels?
Look, I think it is, Pete. I think around 210 to 215, it's in buy zone. I wouldn't necessarily say it's bottomed yet, but I think this is where you start to fish. Interesting, Pete. I mean, I think part of the reason why CSL came off so hard is that it had rallied pretty strongly in the week beforehand into the result. And
Mm.
certainly, I think institutions had said, look, we've had enough of the banks. We're not
Yeah.
sure about resources. Time for CSL to do well. And
Yeah.
there was some money moved in that last week. And then that's part of the reason why it fell so hard. But look, it was I just think it was a function of the report took the market by surprise, in particular, cost cutting and also, closure of some centres, some blood plasma centres, and the spin-off of Seqirus. And I think the
Yeah.
market wasn't ready for that.
But Paul, if you're a current shareholder, and let's just imagine that, you might not be out of pocket too much because you were in for a while when I was rising, shouldn't you look at the sell-off of Seqirus, the buyback in next year, 750 mil? They're positives, aren't they? And also, if management say, well, we're going to get rid of 3,000 workers and cut costs, that's all good for the future. And I'm sort of seeing this as a sensible short-term reaction. But if I'm not even holding CSL, I would have thought in 2026 they should be reporting much better figures.
Yeah, you're right, Peter. And you look at the fact that the CSL on a forward price earnings basis is under 20, right?
Yeah.
That's actually less than the market. So what's wrong with the market's view on CSL? So I think for long-term value investors, CSL, this company is still growing profits at high single digits,
Yeah.
and will again next year. It's attractive. The only question mark I have, Pete, and timing is everything, as you know, in markets. What's the immediate catalyst to take it higher? And it's not clear what that is. So I reckon you buy some now and you keep some, and if it goes lower, you buy again, right? I don't think you put all your, I don't think you necessarily need to go into it guns blazing, but it's certainly in the buy zone.
Okay, what about James Hardie? Have you had a chance to think through what happened there?
Yeah, I'm a little less comfortable on James Hardie. I think it almost reminds me of, things come in threes. We've had two out of the three so far. We had the bots takeover in the sense of the way they handled the market. We've had the underwhelming profit report, which they've had so much time to tell the market that things were doing hard in the US, and they hadn't. So I'm always waiting what the third is, and that is what makes me just a little bit wary about James Hardie. Also, on an outlook sense, I mean, clearly, they depend on the renovations market. People both, upsizing, resizing, renovating, trading up in houses. And in the US, that's where their main market is. And that's slowed down, and it's slowed down partly because a lot of people can't afford to refinance because they're on very high fixed term interest rates. And can't afford to get out of those. So it seems to me that outlook's a little soft at the moment, Pete. So I'm not into James Hardie yet. I think it's done enough to sort of really make an investor very, very wary about what the game plan for the company.
Okay, mate. Well, thanks for joining us, and we'll catch you next week.
Thanks, Pete.
And that was Paul Rickard from his country retreat. Obviously, a family member decided to join at the end of the show. That's the show for this week. Thanks for joining us. Don't forget, if you want to know more about stocks and other insights that we offer anyone who's an investor in the market, have a look at the Switzer Report. Go to switzerreport.com.au. Thanks for joining us. I'll see you next week.